Hi everyone, as you are filtering in here, I will do a quick introduction for myself and go over a few housekeeping things so that we can get started. So my name is Ellie Moffett. I'm really glad that you're here with us today. I hope that you've joined us for past webinars and I hope you plan on joining us for future webinars. First and foremost, if you are here for CPE credit, we do need you to do a few things in order to receive that CPE credit. The first thing we'll need to have you do is answer our poll questions as they pop up on your screen. If you have any trouble at all, message me immediately. You can always send me your answer as a chat or in the Q&A box as well. We will also need you to fill out the survey at the end of this webinar. You can do that one of two ways. That will pop up automatically for you as you are exiting the webinar, and it will also be emailed to you in 24 hours. There's no need to fill it out both times, but you do have a couple options for filling out that survey. A couple other important things to take note of as we're getting started here. If you have questions as we are going along, please ask us. We will answer your questions at the end of this webinar. And if we don't get to them at the end of the webinar, we'll follow up with you. Via email. So please don't hold back. Please ask your questions. We are here to answer them for you. We will also be sending out the slides once the ball gets rolling a little bit here. I'll be linking those in the chat box. That's also where we will be linking the handouts for today. So a quick introduction for Sales Tax and More. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax or related needs. So we do a lot of returns, registrations, consultations, research, and like our name states, more. So if you have questions about our services, please reach out and ask. We're happy to answer those questions. And a quick introduction for our founder, Mike Fleming. Mike's state tax knowledge is very well-rounded. He's one of the United States leading authorities when it comes to e-commerce, nexus, service providers, and dropshipping. Over the years, he's assisted thousands of sellers, both foreign and domestic, with their taxes issues in the United States and Canada. And I'm really just fumbling through these introductions the last couple of days, Mike, so you take it from here and see if you can do any better.
All right, Ellie, thanks very much. Very nice introductions there. Before we get started, for those of you who have been on our recent webinars, we do talk about COVID-19. We've been talking about staying safe, staying healthy, being leaders in our firms, in our families, keeping a positive outlook. Not everyone is handling this forced social isolationism as well as others. So as we begin to reopen the governments, some states like here in Texas, we're still hitting new highs every day in the number of new cases being reported. We're still, hitting new highs every day in the number of deaths that are being reported. So we're supposed to be wearing masks when we go out. We're supposed to still be social distancing. Be safe. If your state is one that is saying that excuse me, I'm losing my voice. If your state is one that's saying that, yes, we're opening back up because we can't stay closed forever, but they are recommending masks and everything else. Be leaders, with your clients and in your family, and, try to do what the government's asking. We don't want this to continue to get worse or get a second round, especially in states like Texas where we're not hit the midpoint yet or the high point yet. But we do have some resources out on the website. A lot of states have been pushing back the due dates. We talk about, we've got a little snippet here and also a blog post. We talk about not all extensions being created equal. And, the difference between a sales tax extension and an income tax extension are vast. When we're talking about income tax, that's always your money. It's coming out of your pocket. And yes, the state may slap your hand, give you some penalty and interest if you don't pay that back. If you don't file and pay that on time. But it's your money. Whereas sales tax, it's generally not your money. It's either the state's money or your customer's money or your client's customer's money. And it's a trust tax. So there are criminal penalties up to and including jail time for tax collected and not remitted. And you're not hearing the states waive any of that. If you fund your business with credit cards or, even money from your income tax, and your business happens to fail or your client's business happens to fail, and we don't want to wish that on anyone, but if it does, that's really bad. And you don't want to add to that. If you funded your business during these tough times with credit cards, you can always walk away. You can always file bankruptcy. But sales tax, you can't. There's personal responsibility in there. It generally survives both a business bankruptcy and a personal bankruptcy. So as bad as things are, they can get worse if you don't turn in your sales tax. So a lot of our clients are actually asking us, we do a lot of sales tax returns, and they, the quarterly, they say, please hold on to the quarterly money also, so we don't get tempted to use it. So a lot of these states, they're giving, taxpayers extra time to file, not so that they can fund their businesses with the sales tax, but because they know that their people may not have access to the data or their accountants, may all be working from home and they don't have access to the data. So it's more of an ability to file those returns late. In some instances, like Governor Newsom out in California, he's actually telling you, hey, get a year's free, tax-free loan. I think his heart's in the good place, but I don't think he understands sales tax, because they're saying, well, California is not going to lose any money because we're just delaying any penalty or interest that these people would pay. But unfortunately, not all businesses are going to make it through this time, and some businesses will fail. And unless the governor comes out and says, we're, taking away this personal responsibility, and unless they come out and, change things, and they're not going to pursue businesses that fail for sales tax, I would never use sales tax to fund my business. Lots of other money. I would use money that I had put aside for income tax to fund my business, but I would not use sales tax. So just want to bring that up. Some states, even remind you of that. Lots of states have put out statements like this. This one's from Maine, and I've highlighted the areas. So the first one, it says, unlike income tax, sales tax and state withholding tax are trust fund taxes held in trust. That's why we say it's not your money or your client's money. It's either the state or the customer's money. And you're just the tax collector. Next highlighted section, Maine law prohibits taxpayers from using these trust funds for their own purposes. So I thought that this is a great example. There are other states putting out statements like this, but I like the way that this is very succinct here. All right, so if anyone has any questions about this or wants to talk about it, please reach out. But let's get on to what we're here for today. And that's Canadian sales taxes. And today we're going to cover GST, HST, PST, QST. I call Canada the alphabet soup of taxes. I mean, there's all sorts of different letter combinations here. We're going to go through all of them. Canada does have a digital tax with an economic nexus. We're going to go over that. It's limited to Quebec only, but we'll touch on that. We're going to talk about rates for invoices, how they should appear on an invoice. And it's different from the US and it's different from the European Union. So I think that's important. We're going to talk about the Canadian equivalent of nexus, because they don't use that term. We'll talk about input tax credits. We'll talk about filing frequencies and registration timeframes, because they're vastly different than here in the US. I'm going to turn off my camera. I start looking all over the place, and I find that very distracting. I don't want to subject you to it. So I am going to turn it off during this polling question, and then I'll open it back up during the question and answer section at the end of the webinar here.
Yeah, we want to get a good idea of who's in the crowd today. We want to know which applies to you. Do you currently sell in Canada? Are you thinking about selling in Canada? Do you have clients who are selling or thinking about selling in Canada? Or are you here for CPE? And Mike, so far, a lot of people are currently selling in Canada, but we do have a pretty good mix in the crowd today. So we'll leave these polling questions up for 15, 20 seconds. We're going to close this one out in about 5 seconds here and move on. So thank you, everyone.
Okay. We're going to do a very high-level overview today. So we're going to get into a lot of detail, but there's only so much you can cover in an hour. So we want to get you exposed to these things, share some knowledge with you, but we can't possibly, cover everything there is to know in 1 hour. So we're going to start out very high level here. Number one, there are 2 levels of tax. We've got the federal level, which is, unlike the U.S. U.S. only has local taxes, that are collected by the states when it comes to sales tax. But in Canada, they have a federal level. And at the federal level, it's called the goods and services tax. And that's actually a type of value-added tax, a VAT. They also have local level taxes, and these are collectively referred to as provincial sales taxes, or PSTs. Some of those are actual sales taxes. Some of them are actual value-added taxes. For those of you who haven't seen a map of Canada, the 3 on the top there, those are what we call territories. So there are 3 territories in Canada, and there are 10 provinces. And the provinces are listed along the bottom there. So you've got 13 jurisdictions in Canada. That's a lot less than the US. But if you wanted to register everywhere, there are only a maximum of 5 registrations. So it's a little bit color-coded here. So I'm colorblind. I can't tell you what these colors are. But white means there are no local taxes. So in Alberta, we don't have any local taxes. Yellow means those are individual registrations. And then, we have the HST provinces, whatever color that is. And we're going to get into what HST provinces are. But these are the 10 provinces. When you register for the GST, HST, it's going to automatically register you for the HST, which is the local level tax in New Brunswick, Newfoundland, and Labrador, Nova Scotia, Ontario, and Prince Edward Island. And again, we'll get into this a little bit deeper. But the maximum number of registrations you can do are 5. So if you get the GST, HST registration, you've got the British Columbia registration, you've got the Manitoba registration, you got the Quebec registration, and the Saskatchewan registration. So those are the 5 maximum registrations if you wanted to register everywhere. The 3 territories, once you're registered for the GST, you're going to collect in all 10 provinces and 3 territories, but there are no local taxes in those 3 territories. So a little bit of an overview. The GST, many of us have heard about that. That stands for Goods and Services Tax. It is a value-added tax. It's a tax that's collected at every step of the supply chain. So there are virtually no exemptions. There are, some, but virtually none. Virtually everyone pays at every step. So it's not like the US where, we have sales for resale and you collect a certificate. When we're talking about the GST, in most instances, everybody pays at every step along the way. But once you're registered, you get to take what's called an input tax credit. And that's how you prevent double taxation in Canada with this input tax credit, which we're going to spend some time on. The GST is remitted to the Canada Revenue Agency, or CRA, and it's got a rate of 5%. So that's a real quick overview. And a value-added tax is a tax on the amount by which the value of an article has been increased at each stage of its production or distribution. So, you know, we talked about this input tax credit very briefly, and we're just going to touch on it briefly again now. Once you're registered for the GST, then any tax that you pay in the legal course of business, you get to take a credit for. So if I'm a reseller, when I'm buying something, yes, I have to pay the tax on that, but I'm going to then collect tax from all of my customers. And at the end of the year, a lot of GST is annual filings. I'm going to add up all the tax that I collected. Then I'm going to add up all the tax that I paid and, you know, just remit the, I'm going to subtract what I've paid from the amount I collected, and I'm going to remit the difference to Revenue Canada. So that's how we're preventing double taxation. And, you know, that's where this type of tax gets its name from, just on the value added. Because even though I'm paying tax, you know, on my purchase, I'm getting that back. So only the tax on the change in value is actually getting paid to Revenue Canada. In Quebec, you know, we'll get into it, has its own sales tax called the QST. It's a value-added tax, and the rules for it are pretty similar, but there, this input tax credit is actually called an input tax refund, or ITR. So we've got different types of GST. And the two we're going to talk about today are Division 2 and Division 3. Division 3 is the invoice tax. You know, whatever tax is shown on the invoice and is collected from customers is the Division 2 GST. It's the one we're most familiar with. Division 3, I really wish they would call us something else other than GST, because it just confuses the issue. Even for companies in Canada, this confuses the issue. And what Division 3 GST is, it's sometimes called the cross-border tax. It's the tax that's paid when you're clearing customs. So say you're shipping something to a warehouse, an Amazon warehouse in British Columbia. Whoever's shipping that for you, whether it be, you know, DHL or FedEx or UPS, they're usually clearing customs for you. And they usually pay this Division 3 GST. It's generally 5%. Sometimes it's broken out very clearly. Sometimes it's lumped in with tariffs and other charges. But you're paying that, and it's a hard cost. You know, sometimes people say, well, I paid the tax when I was clearing customs. Two totally different taxes, and we're going to get into that a little bit more later on. So let's talk about local level taxes real quickly. As we mentioned, Alberta and the territories don't have local taxes. British Columbia, they do have a local tax. It's an actual sales tax. It's called the provincial sales tax. Manitoba, they also have a local tax that's an actual sales tax. We said collectively, these provincial taxes are referred to as PSTs. But if you talk to Manitoba and you say, well, you know, I want to talk to you about your PST, they say, we don't have PST. They have an RST, and it's the retail sales tax. So collectively, they're PSTs, but, you know, if we're talking about individual taxes, they're not always called that. So Manitoba, it is a sales tax. It's the retail sales tax, or RST. Quebec, their local level sales tax is the Quebec sales tax, or QST. It's not a sales tax. It's a value added tax. So sales can be an actual sales tax, or it can be a value added tax. They use these terms interchangeably sometimes in Canada. And then Saskatchewan, they actually call theirs the provincial sales tax, like British Columbia or PST, and it's an actual sales tax. There are 5 provinces that said we want to make things really easy for people selling into our province. So we are going to harmonize our sales tax with the GST. We're going to let Revenue Canada administer this. We're going to let them collect it. We're going to let them put it on their returns, and we're going to trust that they're going to get us the right amount of money. So, you know, this harmonization, the same rules basically as the GST is where we get the HST from, the harmonized sales tax. And the 5 provinces that you're automatically registered for. You don't need to do anything separate. It's all on the same return. You don't even break it out on the return. You just lump it all together. So they do make it pretty easy. It's New Brunswick, Newfoundland and Labrador, Nova Scotia, Ontario, and Prince Edward Island. So these are the current 5 HST provinces. There have been more. You know, sometimes these provinces want to try it out, like British Columbia. They said they wanted to, you know, harmonize, and they tried it for a while, didn't like it, and then they backed back out. But right now it's these 5 provinces. The HST overview, as we mentioned, you know, it's harmonized with the GST. It simply means the same rules. It's only collected in 5 provinces. It's remitted to Revenue Canada or the Canadian Revenue Agency on the GST return. Again, those are the 5 provinces. So QST, for the most part, it has the same rules as the GST and HST. You know, in Quebec, they're French, so they've got to be a little bit different. So some terms are different, but they pretty much follow the same rules. So we talked about input tax refunds rather than input tax credits. And again, GST, no matter what province you're in, it generally is going to go to Revenue Canada. However, and by the way, if you're not registered for the QST, then the GST, even in Quebec, goes to Revenue Canada. However, once you get registered for the QST, now the GST that would normally be going to Revenue Canada goes to Revenue Quebec. So a couple of small changes there. Everyone else, it always goes to Revenue Canada. Quebec, it all depends on whether you're registered for the QST or not. Now, one major difference in Quebec, none of the other provinces have this yet. It's not part of the GST at this time, is the economic threshold digital tax. It's got an economic threshold, and it's a digital tax. So effective January 1st, 2019, foreign sellers or marketplaces with no physical presence must register if their taxable sales cross the rolling 12-month $30,000 threshold. So it's a fairly low threshold. And you sell services or incorporeal movable property. That's just a fancy way to say cloud services, downloads of digital software, music, entertainment projects. So they use some different terms, but it's basically a digital products tax. They do have a special registration for this. You can register for the QST only. GST, HST registration is not required. So it's quicker, it's easier, you know. However, it may not be the best path to go because input tax refunds or input tax credits are not allowed if you only are doing this special registration. So if you're selling digital products plus tangible personal property, you may want to do the normal registration so that you can get credit for any of the GST or HST or QST tax that you're paying in the normal course of business. So you can take that as a credit. If you just do the special registration, you cannot do it. The penalties start to add up. The penalty is $100 or 50% of the QST per transaction, whichever is higher. The QST, I believe, is 9.875 or so. So it's a fairly high tax rate. So, 50% of that, starts adding up over time. All right. So Ellie, let's go to the next poll question.
That should be up on everyone's screen right now. So there are 10 provinces and 3 territories in Canada. How many registrations are there? The choices are 13, 10, 3, and 5. So we will leave this open about 10 more seconds as these questions roll in. Mike, I think you're going to need to review this one a little bit. We're kind of split between the answers 13 and 5. So if you want to go over this, we'll close it out and move on.
Yeah, absolutely. There are 10 provinces and 3 territories. So there are 13 jurisdictions in Canada, but there are only 5 registrations. And those 5 registrations cover those 13 jurisdictions. So 5 is the correct answer there.
All right. Thank you so much, Mike.
All right. So let's talk about the Division 2 GST a little bit more detail. This is the GST that actually appears on an invoice or that you're collecting from your customers. So biggest question that we get is, when do I need to collect Division 2 GST? Well, when you're carrying on business in Canada, and by the way, carrying on business is what the Canadian equivalent of nexus is. So they don't use the term in nexus. They say when you're carrying on business in Canada, when the place of supply is in Canada, and when the transaction is not exempt. Now, we said there are virtually no exemptions, but there are a couple, and we're going to, touch on them in the next couple of minutes here. So carrying on business, that's the Canadian equivalent of nexus. And by the way, a lot of people think that the U.S. is very gray when it comes to nexus. After you look at some of what Canada says, you're going to think that the U.S. is black and white. In Canada, it can be different per industry. So, there's a list of 12 factors, and you can have the same factors for 2 different companies. Same exact factors, so same exact fact pattern, except they're in different industries, and one may be deemed to be carrying on business in Canada and the other one is not. So I sort of joke at this, how do you tell when you have business in Canada, or when you're talking to, representatives of the CRA? And, it sort of feels like, well, we'll know it when we see it. It's not quite that bad, but like I said, you can have 2 companies with the same exact fact pattern, and one may be carrying on business and the other is not. So definitely not going to be black and white. So here are the 12 factors. And the more of these factors you have, the more likely it's going to be that you are going to be deemed, or your client is going to be deemed to be carrying on business in Canada. So some of these are, look fairly easy. Some of them are not. When you start talking about advertising, Canada's pretty aggressive. So, advertising is in places, the place from which transactions are solicited. So if you've got advertising going on in Canada, then that will sometimes count as where transactions are being solicited is in Canada. But the place of delivery, well, if you're selling into Canada, if the place of delivery is generally going to be in Canada. The place of payment, if you have clients working through Amazon Canada, the place of payment is in Canada. The place where purchases are made or assets are acquired, where you're sourcing your products from. A lot of times that may be Canada. The place from which transactions are solicited. So if we use Amazon, they're being solicited from Canada. Location of assets or an inventory of goods. You know, they just came out with a new program on Amazon, so some of that is being stored in the US. But the traditional method is you store your inventory in Canada. So, you know, having Amazon, using Amazon CA and keeping inventory in Canada is generally going to be enough to be deemed carrying on business. Place where the service is performed, you know, bank accounts, merchant accounts, these are all included in these 12 factors here. So if you're selling through Amazon Canada, you're going to rack up a lot of these factors here. And that is something that if you're selling through Amazon Canada, definitely going to be creating, deemed to be carrying on business. All right, so what determines the place of supply? You know, is it in Canada or is it in the US? So the contract or the agreement, you know, two things with that contract or agreement we got to look at. We got to look at the language and we got to look at the date. And in Canada, unlike the US, shipping terms play a major role. Perhaps the most important thing is, where do title and risk of loss pass? If they pass in the US, then, you know, that's going to be where the place of supply generally is. If they pass in Canada, then that's going to be where the place of supply is. The importer of record is not material. You know, many years ago, it was a lot simpler. And they said, well, who's the importer of record? And that determines the place of supply, but not so much anymore. They don't really look at that. It's really where the title and risk of loss pass. And in the shipping terms, and especially the Inco shipping terms, that's going to be spelled out in there where the title and risk of loss actually pass. A common mistake, and this is called supply before release, and many companies, even Canadian companies, get this wrong. And it says, for the purposes of this part, a supply of goods that, by the way, a supply of goods is another way of saying a sale. So a supply of goods that have been imported in compliance with the Customs Act or any other act of Parliament that prohibits, controls, or regulates the importation of goods, but have not been released before the goods are delivered or made available in Canada to the recipient of the supply, shall be deemed to be made outside of Canada. So a lot of times, if you have something clearing customs, people will point to that and say, well, you know, it's, we don't have to collect the tax because, you know, we're going to rely on Section 144 of the Excise Tax Act. Now, why that's a mistake. You know, agreement as supply, which is Section 133, can be mean that the supply is actually happening in Canada. So what this basically says is the entering into the agreement shall be deemed to be a supply of the property or service made at the time the agreement is entered into. So that's why we say, you know, not only do you have to look at the language of the contract, but you got to look at the date, because before you even ship something to Canada, most of the time you have some sort of an agreement in place. And if you look down on the bottom there, it says Section 144 will not apply if the goods have not been imported before the agreement for the supply is entered into. So you got to ship it and then sign an agreement, which that's just the way business usually doesn't happen. Big mistake here sometimes. So let's start talking about exempt supplies. We said very little. And they're not. Most health services is an exempt supply, most educational services, most financial services, and long-term rentals of homes and any tolls. Now, when you're selling exempt supplies, you're not allowed to take input tax credits. So there's a difference between an exempt supply and a zero rated supply. So very few exempt supplies here. But there are also exemptions and rebates So you have indigenous peoples, First Nations. Some provinces have exemptions, very few others. Now they have what are called point of sale rebates. Children's clothing is one of those, and it can be at the GST level, the federal level, or it could be at the local level. And on this, it's not really an exemption. You know, the way the mechanics work is that the GST is actually collected but rebated immediately. So it's all one transaction. It creates more of an accounting problem than anything else because they're not paying the GST because it's a payment which is immediately offset by this rebate. But it does create a lot of accounting headaches. And then we go back to zero-rated supplies. So a zero-rated supply means that something is subject to the GST. However, it has a rate of 0%. And the reason why this is an important distinction from an exempt supply is because ITCs, input tax credits, are allowed. So remember, any tax that you're paying in the normal course of business, then you can take a credit for. So if something is zero rated, you're allowed to take a credit for any of that tax you pay. If something is exempt, you're not allowed to collect or utilize the input tax credits. So basic groceries, agricultural products, prescription drugs, medical devices, these are all what we call zero rated supplies. They're not exempt. They are subject to the GST, but they're just subject at a rate of 0%. May seem like semantics, but it's important because one allows the ITCs and the other doesn't. So how is double taxation prevented? Well, we've been talking a lot about input tax credits. And as we mentioned earlier, registrants are allowed to recapture any GST or HST that they paid related to commercial activities. So any GST or HST that you pay in the normal course of business. This does include Division 3 GST, which we haven't started talking about yet. You're allowed to pay yourself back with the tax collected. So you're basically refunding yourself. And you don't do it on a per item basis. You count up all of the tax you paid and you count up all of the tax you collected, and then you subtract the tax you paid from the tax you collected, and you only remit the net difference to Revenue Canada. And for a lot of you or a lot of your clients out there, you're going to be on an annual filing. And we're going to talk about, filing frequencies, but a lot of people out there, file this once a year. So you're paying yourself back immediately. In the way you get your return to balance, because you're going to have collected a whole bunch of tax over the course of the year, is by using these credits. So you cannot take a credit for a period where you weren't registered, but if you are registered, you have up to 4 years to claim these input tax credits. Now, for the QST, it's the same thing, but instead of calling it an ITC, we call it an input tax refund, and that would go through Revenue Quebec rather than Revenue Canada, but the same process. All right, Ellie, let's go to our next polling question.
Yeah, we have a true or false question up on the screen. Double taxation is a big problem in Canada. True or false? And Mike, right now, most people are answering false. We're going to leave this open about 10 more seconds. And then we can close it out and move on. Go ahead, Mike.
And that is the correct answer. If we didn't have an input tax credit, it would be a big problem. But because of the input tax credit process, it is not a big problem.
All right. Thank you so much, Mike. We're going to close this out and keep moving.
All right. So let's talk about Division 3 GST. And Division 3 GST is a tax imposed on the importation of goods into Canada. So it's sometimes called the cross-border tax because it's crossing the border. This is when the GST, Division 3 GST gets paid. And it's paid whether the importer is registered or not. So you may not have a responsibility to collect the Division 2 GST, that's the GST on the invoice, so you may not be registered. But you may still be required to pay the Division 3 GST. So if you're an importer, you have to pay the GST or the federal part of the HST on most commercial goods that you import into Canada. Now, you may or may not be considered to be the importer. That's a whole different question. But if you are the importer, then you're responsible for paying this Division 3 GST, whether you're registered in Canada or not. And sometimes I talk to people, they don't even realize they're paying this, you know, because it's being paid by whoever's clearing customs for you. So maybe it's, you know, FedEx or, you know, one of these other logistics companies or shipping companies. And they don't even know they're paying it until I point it out to them. And there's a reason to voluntarily register in Canada, even if you don't have a responsibility to do so, just so that you can get these input tax credits, because otherwise that 5% can be a hard cost. So the only way to get that back is by registering to collect the Division 2 GST. We mentioned both, excuse me, Ellie, I've caught you stumbling here. We've talked about the cross-border tax. We talked about the importer of record. This is separate from Division 2. It's almost like it really is a separate tax. I wish they would call it something different, because, you know, it gets very confusing. So sometimes the customer says, well, I'll just pay, you know, the tax when it crosses the border. Well, if you're registered in Canada, just because your customer pays something as it crosses the border doesn't relieve you of your responsibility to collect the tax on the invoice. They are two different taxes. So you got to be careful there. And, you know, this comes back to sometimes the Canadian companies don't really understand how this works themselves. And they're talking their customers into, their suppliers into positions that may hurt them in the long run. So input tax credits can be taken for both Division 2 and Division 3 GST. So, you know, if you're registered, you know, in theory, if you're importing into Canada, it's just easier for you to pay the tax when it crosses the border, charge your customer, pay yourself back. That's the cleanest way to do these things. All right, we talked about before, you know, this is just a GST, HST policy statement where it talks about you may not have the responsibility to get registered to collect the tax, but you still may have a responsibility to pay the tax upon importation. So big distinction there. All right, so what happens if the Division 2 tax is not collected? This is a question we get all the time. Well, if the tax is not collected and remitted, the tax becomes the responsibility of the seller. So just like the U.S., you can be audited, you know, and you can be audited by a province. You can be audited by Revenue Canada. There is a VDA process in Canada, but it's usually got a 10-year look-back period. It's really the same thing as the U.S. Now, Canada and the provinces are not as aggressive as some of the U.S. states, but not as aggressive doesn't mean that they don't audit. They do audit. All right, so we talked about voluntary registration before. You know, sometimes a seller wants to register voluntarily so they can take advantage of the ITCs. Unlike the U.S., you know, where, you know, compliance costs, that's a true cost. But in Canada, you can get registered and actually, you know, increase your bottom line, because that 5%, which is a hard cost, now it becomes really a pass-through cost. You are, you know, paying it, but you're paying yourself back when you're collecting the tax from your customers. So sometimes it makes good business sense even if you don't have a responsibility to collect the tax, to do so on a voluntary basis so that you can take these input tax credits. Filing frequencies, a lot easier than the US, at least for the GST and the HST. If you have less than $1.5 million in annual sales, that's Canadian dollars, then you're generally going to be an annual filer. When you cross $1.5 million in Canadian sales, then you become a quarterly filer up until the point you hit 6 million. And once you cross 6 million, then you're a monthly filer. So most people, when they're starting out, they're going to be less than that $1.5 million, and they're going to be an annual filer. So you can say, hey, I want to be a monthly filer. I don't want to hold on to this money that long. They'll let you do that. And same thing with quarterly if you want to choose a quarterly, but you don't have to do that. You know, you're automatically going to be listed as an annual filer if you have less than $1.5 million in sales, unless you request otherwise. Now, the other provinces are not anywhere near as generous, and you're going to most likely be monthly or quarterly. British Columbia used to let you change your filing frequency pretty easier, and you can say, hey, I'm an annual filer for the GST. Can you just match me up so that I can do all my filings at the same time? They don't do that anymore. Now they say that, you know, you've got to have at least 6 months of payments before they'll look at changing your filing frequency. And, you know, I can't find anywhere where they actually tell you what the rules are for being quarterly or monthly. What they have told me verbally, and I can't find anything to dispute this, is that it's done randomly. And for a while, we do a lot of Canadian registrations, and for a while, everyone was coming back as quarterly. Well, for the last 1.5 years or so, that's not been the case. Everyone's been coming back as monthly. And they can't change until after you got 6 months worth of payment history. Once they see that, then they are willing to work with you and change it to a quarterly or sometimes annual filing frequency, depending on how much money you're remitting. So generally a lot easier than the US. Something we need to talk about is security deposits. So all non-resident registrants, so anyone from outside of Canada, they need to keep a security deposit. And it's a pretty hefty security deposit. It's 50% of the annual net GST paid. It's got a $5,000 minimum and a $1 million maximum. So it can be a cash deposit. It can be a bond. You know, when you're first getting registered, you don't know what your, you know, volume is going to be. So in your new registrant package, there's a limited volume waiver available. And most of our clients go ahead and take advantage of that. They don't have any security deposit due the first year. You know, if you're remitting more than $3,000 net GST, you're supposed to go ahead and put the security deposit down. But most of the companies that we work with and that we've talked to generally don't do so. And there's not a big impact of not doing it. Canada's going to collect all of the taxes that you want to remit. They're not going to give you a hard time about it unless you're due a refund. And if you're due a refund where they're actually going to send you money, they're not going to send it to you. They're going to apply it towards the security deposit. Again, most of the companies that we work with don't pay it unless, you know, you're a big publicly traded company or something like that, and you got to worry about compliance, and they want to make sure that all the I's are dotted and T's are crossed. So it all depends on your facts and circumstances. But, you know, if you get this paperwork, it looks pretty scary. But there's a way around it. There is this limited volume waiver available. All right, so the registration timeframes. You know, foreign sellers do not usually have social insurance numbers. That's the Canadian equivalent of a social security number. So we generally don't have that. So we can't file it online. These have to be remitted manually. And they now have 3 offices based on your geographic location. And these offices are backed up. Registrations can take as long as 4 or more months. The one that takes most of the registrations, I'd say up to the East Coast, but it's not exactly geographic 100%. But it also takes any other country other than the US, they're up to 6 months. So, I mean, the time frames can be really long. And even though I explain this to people, people start getting, hey, when are we going to get an answer? Well, it could be 6 months. You don't want to wait for an approval to start collecting tax. Unlike the US, they generally want you to get your approval first and then you start collecting tax. Because this process takes so long, even if your application says January 1st, if they approve you on June 1st, they're going to give, if we're doing the registration for you, they're going to call us and they say, hey, has this company been collecting tax? And if we tell them no, they're going to say, well, we can only backdate this registration for 30 days. So we're going to ignore the application date. We're just going to backdate it for 30 days from June 1st. So it'll be May 1st. And the reason why they do that is because they don't want to be able to give you input tax credits for periods when you weren't collecting the tax. So very important, as soon as you start remitting, as soon as you submit your approval, you can start collecting the tax. And now when when Revenue Canada says, hey, is your client collecting tax? And we say, yes. They'll say, okay, send me 3 or 4 invoices showing that, and we'll backdate it to the earliest invoice collected. So now you can get to use those input tax credits that you've accrued over that 3, 4, 5, 6 month period. So do not wait for an approval to start collecting the tax. Once a Canadian business number is obtained, it's much quicker for these provincial returns. And a Canadian business number is the equivalent of a US FEIN number. So as part of the GST process, they're going to give you a Canadian business number. And that usually takes, anywhere from 1 to 3 weeks. So that's a lot quicker than a full GST approval. So once we get that, then the provincial registrations are much quicker. Ellie, we need to change that word from returns to registrations. And some of those can be, 3, 4 days rather than this up to 6 month process. All right, so let's talk about invoice requirement. So when it's an HST province, you're going to add the local rate, which is either going to be 10 or 8%. Ontario is 8%. The other 4 are 10%. You're going to add them together. So it'll be 5% plus 8% is 13%. Or it's going to be 5% plus 10%. And you're going to show it as one rate on the invoice. So, and you're going to call it an HST. So the GST is in there, but it's as part of the HST. So just one rate, and that's how you're going to show it on the invoice. And by the way, this is usually one of the questions come up, and this is, even though this is a value-added tax, it's done differently than most of the value-added taxes. The rate is shown separately from the price. A lot of value-added taxes, you got to, include the tax as part of your sales price. You don't do that here. The sales price is listed separately from the tax. Makes things a lot easier. You want to know what type of profits you have, you just plug in a sales price. Tax is going to be handled separately. You don't have to back into the numbers. In all the other provinces, the GST needs to be listed separately from the local tax if you are registered. So like in British Columbia, the local tax is 7%. It's the PST. The GST, the federal level, is going to be 5%. So you actually have to show two taxes on that invoice. You got to show the 5% GST and the 7% PST. And because that PST is an actual sales tax, there are exemptions. So you may have to charge GST, even though they may give you some type of exemption, like a resale or something like that for the PST. We've got a free chart out on the website, and Ellie's going to make this available to you. It goes through all of this. So like in Alberta, it shows you that the GST rate is 5%. The local tax name, it's not applicable. Local tax rate, not applicable. So on the invoice, it's going to be 5% GST. And there's notes out to the side. It says there is no local tax in Alberta. Now, we talked about British Columbia. So the local tax name is the provincial sales tax, or PST. It's 7%. So the appearance on the invoice is 5% GST and 7% PST. So it goes through every one of the different jurisdictions here. This is a great tool if you are selling into Canada, or you have clients selling into Canada. The rates don't change anywhere near as often as the US. And when there is a change, we go out there and update this chart. All right, so Ellie, we have any questions at this point?
We do have a couple questions here. So let's start with, is digital tax exclusive for Quebec?
Yes. So it's the rest of Canada is talking about it, but they haven't done anything yet. So it's that $30,000 threshold is just based on your sales into Quebec.
All right, sorry about that. I was muted. I always forget. So for the Quebec digital economic threshold of 30,000, if you sell other products such as magazines into Quebec, do you track those separately? If you exceed the threshold on the digital, do you have to report the non-digital?
There's different thoughts on that. We advise our clients to do both. And if you are selling digital and tangible, we don't suggest registering through the special QST tax. We suggest getting registered through the normal process, which means you would have to get registered for the GST as well as the QST. By the way, I want to bring this up while we're talking about thresholds. A lot of times, people tell us, well, we haven't crossed the $30,000 threshold in Canada, so we don't have a requirement to get registered. If you read that closer, it says worldwide sales. It doesn't say sales into Canada. So a lot of companies may have, $8 billion worth of sales in the US and $29,000 worth of sales in Canada. And they're telling me, hey, we don't need to register because we're not over this threshold. Now that's not the way it works because your worldwide sales are over 30,000. So I just wanted to bring that up. That's usually a question we get quite often.
All right. So next question we have here is, it sounds like carrying on business is more physical nexus than economic nexus. Is that correct?
Yeah, in general, Canada, except for Quebec, doesn't have an economic nexus at this point. So it's going to be a combination of those different factors. Generally, by the time you get to 3 factors, you're probably carrying on business in Canada.
Okay. And it looks like those are all of our questions that we have here. Mike, is there anything else that you want to say in the last minute or so here?
No, other than we appreciate everyone for coming today. Give us some brutally honest feedback. Also, let us know what other webinars you think would be of interest, and continue staying safe, staying healthy, and trying to stay profitable in these tough times.
Yeah, thank you everyone again. We hope you join us. We have another webinar coming up on Friday, and in the coming weeks we have a few as well. So please join us. We're grateful to have you here and hope that you have a great afternoon.
Thanks everyone. Bye-bye.